The last one of the financial statements is the statement of cash flow. So, statement of cash flow. And the statement of cash flow is very important, very, very important because it basically analyzes all the cash that's coming in and that's leaving your company. The two, the first two financial statements that we looked at, both the income statement and the balance sheet, they they are basically accounting for all the account transactions that occur, but when there's an account transaction occurring, it doesn't mean necessarily that the cash is moving right away. So it might be that the cash has already moved hands, or it might be that it's going to take a little while for cash to move hands. So, for example, if a say I'm Apple and I bought a company, then I'm gonna put that in my books once, but it might be that I'm paying the company little by little. So cash is leaving my hands, my company is slower than what it seems like from my balance sheet. So, you know, with the statement of cash flow, you actually is the only way that you can have a clear picture of where your cash is going. And you need cash to do things. You can't have just what's the number on your books. You can't rely on that to, to say buy materials and buy goods. You need to know exactly how much cash you've got in the bank before you can do something with it. So let's see how the statement of cash flows work. So the statement of cash flows has three parts. One is called operations. The other one is called investing, and the last one, financing. So basically, what happens here is each one of these parts of the statement of cash flows will be telling us how cash is moving. So, for example, when I'm doing my income statement, and I discount, in my operating expenses. Remember the second part of our income statement, the operating expenses. There's this thing called depreciation. Depreciation. And basically, depreciation is an accounting way of discounting the value of something I own. So, what say I buy a computer, and that computer costs me $1,000. As an accountant, what I'm gonna think is, how long will that computer last for me? So say that the computer will last 4 years, for example. So I have a $1,000 computer that will last me 4 years. So as an accountant, what I'm gonna say is, over this 4 year period, I'm going to depreciate the value of this computer until at the end of the fourth year it's worth $0, because in theory I'm only going to use this for 4 years. So that's the logic behind depreciation. So at the end of the first year, I will depreciate $250. So basically, my computer will be worth $750. Basically, $1,000 divided by 4, $250, and I will depreciate $250 every year. So end of first year, 750. Second year, 500. Third year, 250, and then finally last year, $0. But what does that mean in terms of cash? Because here, remember, we're talking about cash. Depreciation shows up in the income statement, and basically it is telling me that I've spent 750, that I have the $750, that I have the $500, and that I have the $250. But what happens is, in fact, I only really spent $1,000 in cash, and then that's it. I spent it the first year, and then I don't have that cost anymore. So basically, what happens here in operations is I add back my depreciation because on paper this thing here is worth only $750 or $500 or $250. So it seems like I'm losing money because I paid $1,000 and then that $1,000 turned into $750, that turned into $500, that turned into $50, that turned into zero. But in fact, I still have that asset, so I add back depreciation, and that's one of the examples of things that we do here in operations. We add all the, for example, we add back accounts receivable, difference in accounts payable. So all the things that are bought in credit. So all these operating activities that in all the statements that we were talking about before show up as a difference in cash. If they're not really a difference in cash, they go here into cash flow operations. Investing is normally, if you're either buying stocks or securities or anything in the financial market, or if you are paying, that's where it would go. And here in financing is basically, if you've taken out loans and you need to pay for them, that's how it show up. So how about we go over to an example. Here we have Apple's statement of cash flow. As we saw before, we see the operating activities, we see the investing activities, and we see the financing activities. Let's look at some of the examples that we talked about before. So basically, every statement of cash flows will start with your net income. Because remember, net income is what you get to at the end of the income statement after taking out all the costs that you had to arrive to the revenue that you did. But remember, those don't always mean that you had to take cash out of the bank to pay for something, or that you made all the cash that it's in that revenue. So a perfect example is you account for all the revenue that you made. So all the MacBooks you sold, all the iPhones and whatnot. But say that 30% of the MacBooks you sold were for companies and you sold them on credit. So you're only getting paid for them 6 months from now. So basically, you've already accounted for those in the revenue, but you haven't yet gotten the cash for them. So that's a perfect example of how the statement of cash flows really tells you how much cash you actually have as opposed to what you got in your book. So starting off with the net income, then adding back depreciation like I was telling you guys, and adding back all these different things that was that didn't move cash as predicted in the books. Basically, after accounting for operating activities, we actually have $49 billion more than we thought we would only by looking at the income statement and the balance sheet. So $49 billion after accounting for operating activities. Now looking at investing activities, they have purchased some marketable securities. They have made money in marketable securities. They actually have bought a very significant amount of marketable securities. So basically they're investing, trying to generate money out of that more money. Basically Apple has a lot of cash in hand, so they have to use that cash to generate more money. They can't just let it sit in the bank and not make more money. They can't justify that to their investors. And then, so here are more investing activities: buying buildings, and all those things. And then here in financing, finally, they're buying back stocks. Oh, I'm sorry. They're actually issuing more stocks here. So $247 out of issuing more stocks. Here, they're buying back some of the stocks that they put back in the stock market. It's always not always good, but sometimes it's good for a company to buy back stock because that will increase the value of the stock. And then here's some more examples of how they would um, account for all the differences in cash flow. So basically, at the end of the day, they actually had 18 billion more dollars in cash than they would have thought of if they only had the other two financial statements. And then that's it. That's the basics of the three financial statements. Thank you very much for watching.